So let's go over how to build a strong dividend portfolio. I'm going to try and aim this video for beginners, but hopefully there'll be something in this for whatever level of investor that you are. Just a reminder that this is general advice only. Please make sure you do your own due diligence or seek financial advice before making any financial decisions. So I'm going to go over choosing stocks and which mix of stocks to put into your portfolio, when to buy them, and we'll also talk about when to sell them, which, mind you, I do very rarely and usually only when I'm doing a portfolio rebalance, which I only do once per year. And just generally how you can set it up so that it grows over time and sets you up for the future. So let's start with the basics. So you already know that you need money to invest and a trading account. I've covered this in other videos before, so I'm not going to go into it here. But I will say that consistently investing, like budgeting for some money that you're going to put into your investment account over time, is one of the best ways to do it. Little amounts over time really do add up to big results in the end. Consistency, time, and patience is going to be your investing friend because dividend investing is a long-term strategy. Okay, so let's start with this pie chart and say that's your aim. It's going to start off empty if you haven't started investing, and that's fine. But you might already have some investments you can slot in there. Doesn't matter where you're starting from. The biggest thing I want you to take away though, that there is no one perfect portfolio. Everybody's going to have a different mix, a different set of stocks or companies that are within their portfolio. And some people might even be investing in things that are not stocks, like property or something else. And that's all fine. There's no one right way to do this. I personally don't like investing in property, mainly because of all the maintenance and finding tenants and everything. Not to say that you can't make a good return, you obviously can, but I'm lazy. I just like putting money into companies and letting it grow that way. The point being, your investment portfolio could hold anything that's building your wealth. But obviously for the purpose of this video, it's going to specifically talk about dividend stocks and dividend investing. So that's what we'll be concentrating on. So how can you choose which stocks you're going to invest in? So if you have your blank pie chart, you've got to work out which investments you're going to use to fill that pie chart up. Let's start talking about exchange traded funds first, because I think that's a good place to start for most beginner investors. The reason it's a good idea to start with is that you don't have to do any research. Somebody's already done it for you, and you're getting a whole fund worth, an index fund usually, of companies already chosen by the fund manager, so you've got instant diversification. You might also like single stocks, which I do. I like single stocks, but let's concentrate on exchange traded funds first. So I have two exchange traded funds in my portfolio, both Vanguard ones. I've got VHY and VAP. They're both dividend ETFs. One is just a broad company dividend ETF with includes companies that in Australia that hold the highest yield dividends that are also high capitalization stocks, and the other one, VAP, is a property one. You only really need to hold one exchange traded funds. You don't really need two. If you are going to hold more than one, just make sure that the companies within the fund, even if they're with a different fund manager, are different. So you don't want to hold two funds that have the same companies in them because there's no really point. Just choose one of them. And if you're going to hold a second exchange traded fund, just make sure it's a different mix or maybe even a different sector. Let's say you put that as your start and your pie chart is filled up with that one exchange traded fund. So 100% of your portfolio is this one exchange traded fund. You would start investing in this over time. Doesn't matter how long it takes you, but getting to a base of around 10K is a good start. Since most of these dividend exchange traded funds usually yield about a 5% return, and often they're paid 4 times a year, if you've bought around $10,000 worth of that stock, you're going to be getting around $500 return in just the distributions or the dividends. They call them distributions for exchange traded funds. You'll be getting that 4 times a year, so 4 payments of 125 roughly. Sometimes some are more, some are less, but it doesn't matter. It usually roughly equals about $500 for the year. That's not even including the stock price of the value of the exchange traded fund. This is just talking about the distributions. Now, either choose to take this income or reinvest it. That's entirely up to you. And like I said, we're only talking about the dividend payments here, not the value of your portfolio, which will or should be going up over time. Now, you could absolutely stop here and just hold that exchange traded fund, and all you need to do is keep adding more and more money to it and growing it over time and keeping it super simple. Or you might want to throw some single stocks into your portfolio. So let's look at that now. So let's say you've got $10,000 in your exchange traded fund, and now you want to buy some single stocks because you've got the investing bug and it's fun and you're feeling a little bit more confident about growing your portfolio. This is where you're going to have to do some research about which companies you're going to put into your portfolio. I've made videos before on how to do the research, but we'll go over briefly what I look at here. But pretty much you only really need to do this once a year. I only do it once a year. Well, actually, I probably do it a little bit more often than once a year because I'm making videos about it and how to do it. But generally, when I wasn't making videos, I would only do this once per year, around the time I was doing my portfolio rebalance. So as a quick overview, the first thing I do is look at the ASX 200. I only consider the companies within the ASX 200. You would look at an equivalent index in your country, maybe the S&P 500 or so on. Now, the reason I stick with the ASX 200 or the top 200 companies within Australia based on market capitalization is that they're usually more established. You usually have more history and financial data to go on, and it's just a really quick and easy way to weed out all of those smaller companies, the smaller ones that have just come onto the stock exchange that don't have the stability that I'm looking for. Now, of course, these smaller companies can make money. We know this. Some of them can make money quite quickly and through growth. But for me, I'm looking for nice, boring, stable companies that have shown the test of time over the history of how long they've been listed on the stock exchange. So once I've got a list of those 200 companies, the next thing I look at is dividend yield. I look at a dividend yield of 5% or more, mostly because as a dividend investor, you want a good return on your money, and 5% or more is substantially higher than you would get on any savings account in Australia, especially now. So some of the companies within your list might have a higher dividend yield than 5%, and that's fine. You just want something 5% or higher. But of course, dividend yield isn't the only thing that you should be looking at. The next one is dividend stability. And I would argue that dividend stability is even more important than dividend yield. You want to make sure that the dividend that you're receiving is stable. What that means is that the amount that you're going to get is fairly predictable. You know what you're going to get. They pretty much pay the same amount each time, and it's slowly growing. That means you want to discount any companies where the dividend price is jumping all over the place, where one year it might be really low, one year it might be really high, the next year low, the next year high. You just can't predict what your income's going to be. So have a look at the dividend payments over the last 5 to 10 years and just make sure that they've been consistently paying roughly the same amount and growing. Just by a small amount is fine over the long term. The reason that we're looking at such a long time frame is because if a company is able to be paying a sustainable dividend over the long term, it means the company is pretty stable itself. If a company can pay consistently with good stability, it usually means it's a good, solid, stable company. It means it can afford to keep paying that good dividend. Another thing to look at is what the stock price of that particular company has done over the past 5 or 10 years. I don't place too much importance on stock price, but it's good to look at it. So an argument that a lot of people make is, why would you look at a company that pays a 5% dividend if the stock price is falling by 10% each year? Now, if we ignore just normal market declines, like when the market overall is falling or we're in a pandemic, if it's just one of those two scenarios and not the company itself, then it's just a waiting game. It's not a really of big concern because you know eventually that it's going to go back up. But if the company stock price is falling, then it's very likely that it's not paying a consistent dividend anyway. Companies that are failing and the stock price is falling over time are not the ones that are paying consistent dividends. They're the ones where the dividend is erratic all the time, which is why dividend stability, which we talked about before, is much more important. And any quick glance at the stock chart, you don't need to go into much detail, will tell you that. The last thing I look at is debt to equity. Mainly, I don't want a company that is carrying too much debt. Again, this is not going to impact the company overall usually. However, if a company does hold a lot of debt, and let's say we get into a pandemic, you don't want to own part of a company that is struggling to pay its debts back or paying its loans. So this year's been a perfect example of companies that are usually doing extremely well, but if they get into too much debt and can't pay their debts, they may be at risk of folding. Now, this year has been kind of different because the government has been propping up a lot of companies, but it is a bit of a concern when we still don't know what happens when the government bailouts stop and the companies haven't started making a profit yet. So that's why I like, again, nice, boring companies that don't have a lot of debt, because that means that even in tough times, they have enough capital and cash on hand that they won't be defaulting on their loans, and so they'll be able to ride this out. Let's say you've done your research and you've got a list of between 20 and 50 companies. That's going to vary depending whether that's a rising market or a falling market. But from that list, choose 5 of them that you like. You're eventually going to have more than 5, but starting with 5 is a good base. Don't overthink it, just choose 5. All of these companies are probably good companies, and a lot of the times you don't even know until you've been investing in them a long time if they're going to be winners or not. If you can choose the 5 from different sectors, that's even better because that's diversifying a little bit more. So maybe you choose one from the retail sector, maybe one from the banking sector, maybe one is a real estate investment trust. Since you're looking to diversify, you want a healthy mix. Start saving up $2,000 and invest in one of them. Save up another $2,000 and invest in the next one. Once you've got all 5, you should now have about $10,000 in the exchange traded fund from before and $10,000 in single stocks, 5 different single stocks with $2,000 each in them. That means roughly $20,000 in your dividend portfolio now and around $1,000 a year in dividend income. So what do you do next? Well, I would probably go in and build some of the exchange traded fund up now, probably put another $5,000 into it. So you would build that up until it gets to about $15,000. So now you've got 15K in the exchange traded fund and 10K in single stocks, 5 different single stocks. Now I would concentrate on buying another 5 single stocks. Again, saving up $2,000 and buying 5 more of different companies until you have 10 different single stocks. You've got 1 exchange traded fund, 15K in that, and 10 different single stocks with about $2,000 in each of them. So that's around $35,000 in your portfolio now and an income of $1,750 in dividend income only, not counting the fact that your portfolio might have actually increased by now. Now, are all of these going to be winners? No. In my experience of investing, I found that usually about 20% of the companies that you own do really, really well. 20% don't do as good. And the rest, the 60, maybe even 70%, they'll increase in price, but they really won't do anything magical. It's also likely that over time, depending on how long you've held your portfolio, that some of the dividends will be increasing in price based on what you paid for them. So now that you've got 1 exchange traded fund and 10 different companies, what do you do now? Do you buy more single stocks or do you start building everything up? I actually think 10 different single stocks and 1 exchange traded fund is a great basic dividend portfolio. It's nicely diversified and it's easy to manage. Sure, you could hold 100 or more companies within your portfolio, but I think between 10 and 15 is a perfect amount, and even 1 or 2 exchange traded funds. You probably don't need more than that. I personally have a large portfolio and I only have 13 single stocks and 2 exchange traded funds. Okay, so you've built up your portfolio, you're happy with it, you're just going to keep adding to that money over time. And once a year, you're also going to do a portfolio rebalance. This is generally the only time I would say to sell anything. You don't want to be selling, especially panic selling at any other time. So once a year, I usually do this in about April, May, mostly because I don't like doing it right at the start of the year or around the financial year because things can get a little bit jumpy around that time. I like to just do it in a nice, stable time where not a lot else is happening. You go through your portfolio and see what you're holding and which ones you've built up, and just to see how they are all doing overall. Are they still consistently paying dividends? Is the yield that you're getting, the return that you're getting on your money still good? Generally, if they're being consistent with their dividend and nothing major with the stock price has happened, they're a keeper. I don't usually touch it. If the stock price has gone down but they're still paying a consistent dividend, I'll look at why the stock price has gone down. Is it something to do with that company specifically? Or is it something that's global that the entire market is experiencing? If it's just a good global, like a fall in the market overall, I don't worry too much because I know that it's just a waiting game. But if it's company specific, like perhaps the CEO has done something bad and people are jumping ship, or there's something that's quite fundamentally wrong with the company, then I would consider selling that. And the last thing I look for is just whether it's a company I want to keep holding or not. Sometimes a company is still perfectly fine. It's just that I particularly just don't want to hold that company anymore for whatever reason. Sometimes companies just do things that annoy me and I don't want to hold them, but I don't sell them until I'm doing a portfolio rebalance. And sometimes during that time, I think I'm going to get rid of a company and then they'll do something like give investors a special dividend and I'll like them again. So as much as we say to keep emotion out of our investment decisions, sometimes you can't. So you've done a portfolio rebalance and you've got a little bit extra money. Do you put all of that money evenly back into the companies, and could happen at any time when you have money. Do you evenly spread it throughout your portfolio, or do you start building up certain stocks or certain exchange traded funds? I don't have even amounts in all of my investments. I usually will put money in companies that I feel like are doing better and just hold the other ones that aren't doing as well. So I'm usually building up the companies that are doing the best and that are giving me the best return. So my portfolio has different amounts in all of the different companies. So like I said, I don't have even amounts. I just put money into the companies that I feel like are doing the best for me and are giving me the best return. And that could change over time too. Like one year, one particular company is doing particularly well. That's where I start putting a lot of my money. And the next year, another company might be doing well. And I might choose 2 or 3 companies to split the money through of where I'm going to put the money to invest over the long term. But the aim is overall to get to a healthy, diversified, strong portfolio. And because this is a dividend portfolio, one that's going to provide you income over the long term. So that one day you'll have enough in your portfolio that the money should hopefully be able to sustain you and you can be financially free. I hope you found this video useful. Take care, and I'll see you in the next video.